So we'll start discussing case scenario number 16. Following information is related to actions taken in different situation of financial options. Okay. Now situation one, three situations given, action given, exercise price given, premium spot price. See, in this question, if you see, there is no call or put given in the question. Are you all understanding? They want you to find out, okay, whether it is call or put or holding or selling, you need to identify yourself. That is what they have given. Anyway, very interesting question. I don't know if it is purposefully they have given like this. Anyway, we'll see the question, read the questions and then try to understand. From the information given above, choose the correct answer to the following questions. The investor incurs a loss equal to the premium paid in situation 1, situation 2, situation 3, situation 1 and 3. Now, see, this is a very tricky question because they have not given call or put. What we will try to assume is that we will try to understand, okay, see, the investor, since they have given investors, we'll assume that is a holder of a call or put, whatever it is. How we see, first we need to identify whether it is call or put, right? Then we need to understand whether we are selling or buyer. Okay, we need to take assumptions here. See, call or put we can identify through the action, which means exercise price is 2,800, spot price is 3,200, which means a share worth 3,200 in the spot market. You have a right to, which is exercised. So, which means it is in the money. Which option will be in the money? I believe, okay, it is call option. A share worth 3,200, if right to buy at 2,800, then only it will be exercised. So this is a call option. First, situation number 1 is regarding call option, that we can understand. Situation number 2, we will just write it down everything, then we will move on to the question, because anyway without knowing call or put it will be confusing, right? So situation number 2, a share worth 3,500 exercisable at 4,000, which means whether you will exercise, it is exercised also. When you will exercise a share worth 3,500, right, to buy at 4,000, and no fool will buy a share which is worth in the open market for 3,000 by paying 4,000, right? So, which means he has exercised means, obviously this is a put option. This is a put option. Then only the holder will exercise the right. Agreed? Now, in the last case, it is lapse. A share worth 8,000, right to buy at 600, na, there will be no lapse, na. Are you all understanding? Which means a share worth 8,000, right to buy at 6,000, na, obviously it will be exercised. So this is also put option. This is also put option because it is lapse, na. So obviously a share worth 8,000, which is a right to buy it, right to sell at 6,000, na, then only it will get lapse. So call, put and put. This is there, and we will see interchangeably we use holder or seller's perspective. We will see the question, understand. The investor, which, okay, by seeing the question, we will assume that it is, okay, it will also premium paid is there. So obviously, who will pay the premium? Holder will pay the premium. So this is about, okay, investor, holder, na, holder. It is about holding. Now, in which case it is loss equal to premium paid, na? Okay, we will see in which case it is loss, total loss. When he is lapsing, then only the premium paid will be lapsed. See, when he is lapsing, then only the loss, the net payoff will be premium. Premium is how much? 1,000 will be the payoff, 1,000 rupees paid, na? So that is the loss. Now, because he is lapsing the so situation number 1, 2 or 3, I think C should be the solution. Let's verify this. Okay, C is the solution. Now, next, in which situation the option is classified as a in the money? When you are exercising, this will be called as in the money, which means 1 and 2, both options are in the money. Okay, situation 1 and 2, D should be the solution. Next, in situation 2, the intrinsic value of the option. Intrinsic value of the option in situation 2. Now, situation number 2, what is that? See, yes, situation number 2, what is the intrinsic value of the option? Really, see, the value of the option, what is a FSP minus X? In case of call option, it is FSP minus X. Okay, this is call option. In case of put option, it is future spot price. What is that? X minus future spot price. How much is that? 4,000 minus 3,500. 500 should be the intrinsic value of the option. Now, if this is not net payoff. Net payoff means you pay the premium 300, reduce it, you will get 200 as net payoff. So in this case, 500 should be the solution. 3D should be the solution. Yes, 3D, put option, strike price, X minus FSP. Spot price, not future spot price or maturity date, spot price, not today's spot price. Next. Okay, on the date of maturity only you will compare. Okay, next, fourth question. Dash represents a break-even outcome for the investor. See, okay, which situation gives a break-even outcome for the investor? Very simple. Break-even outcome, the net payoff should be 0. Net payoff should be 0, which means equal to premium paid. Which means equal to premium paid. Which situation will give you that? Okay, we'll see. In situation 1, you will pay call option, you will pay 400 premium, and the benefit, okay, right to exercise is also 400. So 400, this I believe this should be the solution. What is that? 1. Situation number 1, option, what is the option? A. 4A should be the solution. Yes, situation 1, intrinsic value equals premium, result in 0. Now, the last question, relationship between spot price and exercise price in situation 2 indicates. Situation 2, okay, spot price and exercise price, what it does indicate. Situation 2, okay, put option, right. So 3,500 and 4,000. Okay, call option in the money, call option out of the money, put option in the money, because obviously exercise. So it is put option in the money. We have classified it into put option now. Yes, put option in the money. This should be the solution. What is that? C should be the solution. 5C. Okay, spot price is exercised. Yes, spot price is less than exercise price, and hence option is exercise. This should be the solution. Here, if you notice, one blunder is there with regards to see, that is why I'm very skeptical about these ICAI solutions. You should be very, very careful. Okay, logically you should apply the concept, but don't get misled by the solution or explanation therein. You have to verify it properly. See, in which situation the option is classified as in the money they have given. You tell me, children. Situation 1 and 2 should be the solution, right? D. Now, what they have given a solution? D, they have given a solution. That is fine. But the solution, if you see, there is a printing mistake or whatever you call. See, the spot price 160. Where is spot price 160? If you see this, the situation 2. Okay, this is 4,000, 3,500 and 300 premium. I don't know where the... Sorry. I don't know where the 160 and 140 came. Anyway, that is spot price more than exercise price. Call option is in the money. That is also fine. But okay, the numbers are wrongly written. You can argue. But here, if you see spot price is less than exercise price of 200, this number also mistake. Hence, a call option is in the money. See, everything is wrong about this. Call option. Should be put option. Why not? Put option only, where spot price is less than exercise price, you will have, see, very simple, right to sell at a higher, if you see exercise price is below, what is there? Yes, exercise price is more than the spot price. Exercise price is more than spot price. Now, you will have right to sell at a higher price. Okay, call option will never be in the money. If the spot price is less than exercise price, which means a right to buy the share at 175, okay, right to, see, a share worth 175, right to buy the share at 200. 175 is available in the open market. No fool will pay 200 and buy the share. Agreed? So call will never be in the money. It is actually put in the money. The numbers are also wrong. The solution is also wrong. Only the option given is correct. At least that much is correct. Okay, D is correct. Anyway, so all these things you need to verify. This I noticed, okay, while I was scrolling through the other solution. Now, next is case scenario number 17. Take case scenario number 17. The company ABC Limited proposes to take over XYZ Limited. The chief executive of company thinks that the shareholder always looks for the earnings per share. Therefore, he considers maximization of the earnings per share as his company's objective. Okay. Profit maximization instead of wealth maximization. Okay. The following information is available in respect of ABC Limited, XYZ Limited. Net profit given, PE ratio, current market price per share. The company is planning to borrow funds as 15% rate of interest and buys out the target company by paying cash. Assume tax rate of 30%. Mergers and acquisition, typical cash question. Okay. Consideration is paid by cash. Okay. The total market value of equity of XYZ Limited is approximately 315034. Okay. See, total market value of XYZ Limited. Let's take this is XYZ Limited. Market value of XYZ Limited. Current market price per share is given as 1,700, and PE ratio given as this much. See, if you PE ratio, if you apply directly to the net profit after tax, you will get the market capitalization. Anyway, PE ratio, see, if per share basis they have given EPS, this is earnings, total basis. Okay. If you convert divided by number of shares, you will get EPS. If you put EPS into PE ratio, what is the 10? You will get the MPS, and then MPS into number of shares will give you market capitalization of the company. But instead of that, directly total net profit after tax is there. Into PE ratio, if you apply, you should get the, okay, what do you say, market capitalization. 315 lakhs into 10, 3150 should be the solution. 1A should be the solution. Are you all comfortable? Okay, 1A. Next. Suppose if XYZ Limited is borrowing funds at a higher interest rate to finance acquisition, it will affect its EPS mainly due to, okay, see, if XYZ Limited is borrowing funds at a higher interest rate to finance the acquisition, which means it is financing the acquisition through borrowing. Okay, levered buyout. Okay, you have heard about it. Okay, anyway, This in case what will happen? Increase in operating profit, increase in interest burden, increase in market price of the shares, increase in tax liability. See, all these are wrong. It should be increase in interest burden. This will increase in interest burden. That's why it will affect EPS. Okay, lever company. Higher interest cost will reduce the earnings per share. Now, next is, suppose if ABC Limited is offering about 4030 lakhs to XYZ Limited for the proposed acquisition, it will result in EPS acceleration, EPS dilution, no change, risk-free EPS. The market has important question. Okay, well, this is a beautifully coined question. If you see, the 4030 is the consideration, which means this much you need to borrow. Okay, you are borrowing and paying it as cash. So which means 4030 is the borrowing. Now, here what you need to consider is that, see, here 15% this is 15%. At what rate you will borrow? 15%. That this 15% is the pre-tax interest cost. This 15% is pre-tax interest cost. Are you all understanding? So what you should do? See, this 15% tax rate is 30 na. Convert the 15% tax rate into post-tax rate first of all. So 15 is there. 15 into 70%. Say 10.5%. This 10.5%, what is the post-tax cost of debt interest? So into 10.5%, first you do. What is the issue? I'll tell you. 4030 into 10.5%. 423.15. Let's say 423.15. Are you all getting this much? Now, what you should do here? First, this company, what is the post-tax profit? 400 lakhs. Post-tax profit of this company, okay, of the merged entity. What is the post-tax profit of the merged entity? 400 lakhs plus how much? 315 lakhs. 315 lakhs. But this, because of the levered buyout, what will happen? This after-tax interest cost will be reduced, na? Yes, you can directly reduce. Why? You converted the interest into post-tax. You can reduce. So 423.15 minus 423.15 lakhs is there. Are you all understanding what is happening? So 400 lakhs is there. Okay, profit after tax of this company plus this post-tax profit of second company delimited minus the interest portion which you have to pay. From after tax only you need to pay interest now. This interest is after tax, hence it is comparable. Minus, just simply reduce the post-tax interest. Are you all understanding? What is this amount coming? First of all, 400 plus 315 minus 423.15. How much is that? 291.85. 291.85. Now, if you see the question, 291.85, EPS. Now you need to find EPS now. What is the revised EPS? Revised net profit after tax is there. Divided by number of shares. If you do, you will get the EPS, post-tax EPS. Here, that is post-merger EPS. Here, if you see, okay, that this is the consideration is by way of issuing new shares or by way of issuing cash or cash, which means existing number of shares will change, will not change, will not change. Number of shares given in the question are not given, not given. You have to work it out. Are you all comfortable? So first, very simple. Market price 840 given, P ratio given. So EPS of this before merger company, you will find out EPS is equal to what? 840 MPS divided by P ratio 10.5. So EPS is how much? 840 divided by 10.5 comes to 80. Are you all understanding? This is 80. EPS is 80 per share. Net profit after tax is 400, which means number of shares you need to find out. Number of shares is nothing but 400 divided by 80. This is lakhs. That's why you will get 5 lakh shares. Are you all comfortable? 5 lakh shares, the number of shares. Now post-merger EPS 291.85. 400 lakhs plus 315 minus the interest cost 423.15 lakhs divided by 5 lakhs if you do. Okay, 291.290.85 divided by 5. How much is that? 58.37. 58.37 is the EPS. Okay, existing EPS is how much? 80. It gets diluted to 58.37. Are you all understanding? EPS dilution is the solution. Even if you don't understand, okay, or entire working, here you can answer, but sometimes they may ask the working. If they gave you 4 different number, what will be the revised EPS? Then you should be in a position to answer. In the solution, okay, what they've given, yes, 3B, post-acquisition EPS will be reduced to 58.37. Are you understanding? I showed you working how it got reduced to 58.37. With this, we are through with the case scenario number 17. Let's take case scenario number 18 regarding FRA. Mark it as important. Very good concept clarifying question, I would say. Okay, some questions in the MCQs, I see that they are good. Okay, concept clarifying question. See, sometimes what happens in descriptive question, even if you don't, okay, reach the depth of the concept, you can answer it. Somehow you can see the steps and replicate and answer the question. But in case of MCQ, if the question, okay, is about precision, is asking, okay, 4 different solutions is given, one you have to choose, and that too, if precisely they want you to answer, if you don't have the conceptual grip, you will never able to answer. Anyway, this question is very important. A Limited is planning to borrow an amount of 300 crores for a period of 3 months in the coming 6 months time from now. Okay, this is, see, after 6 months, today year month 0 you are, this is 6 months, this is 9 months, this is 12 months. This is a year now. Now what do you say? Today you don't need to borrow, you don't need the fund money. You only need money after 6 months, but for only a period of 3 months, right? So what is this called? Okay, 6 into 9 FRA, 6 into 9 FRA. Okay, because after a period of 6 months, yes, from now, for a period of 3 months, 6, total period is 9 months. Okay, the starting period is 6 months, 6 into 9 FRA you should select mostly. Now, where it is, yeah, the current rate of interest is 9% per annum, but it is likely to go up in 6 months time. Okay, the current rate of interest is 9% per annum, and the company wants to hedge itself against this likely change in interest rate. Okay. Now the question here is, what is this current interest rate? I want you to clarify here. Very, very good question. See, if you see, so 3 different interest rate is given. 3 into 6, 6 into 9, 9 into 12. But this is current interest rate 9%. Nowhere given in this 9%. What is this 9%? You may ask. Very simple. This 9% per annum, okay, 9% per annum is the interest rate for a period of 3 months. But starting today, this is a spot 3 months interest rate. This is spot 3 months interest rate. Now, if you put it in FRA terms, just to show you, it is 0 into 3. Okay, FRA, it cannot be called as FRA, the spot rate quoted today. Are you understanding? So, anyway, that is it. You as a CEO has been asked to suggest both traditional as well as modern method. Okay, anyway. Suppose banker quoted this FRA. Banker is quoted this FRA. In the FRA contract, the company is intended to borrow funds in the future. I told you, if you want to borrow fund in the future, if you want to borrow, you will buy FRA, sell FRA. Okay, buy FRA now. Very simple. Here also, if you see the interest rate, 2 things you need to understand. If you want to borrow tomorrow, which means you want to borrow now, as a borrower, you will be long FRA, you take long FRA position, or short FRA, long FRA. Why? All this I explained in the regular lecture. Okay, FRA is nothing but a contract wherein you agree to pay a fixed rate to get a floating rate. Are you understanding? You are buying effectively. Okay, you are agreeing to pay something for the MIBAR. The MIBAR is, okay, the agreed upon rate. Okay, MIBAR or LIBAR or whatever it is. Okay, now the MIBAR concept has changed. Anyway, I'm saying the floating interest rate you will buy for agreed upon fixed interest rate, right? So you will effectively buy the FRA contract. So now here also, this is bid rate, this is offer rate. Okay, this is deposit rate and lending rate. Which rate you will take as a borrower? Which rate I will be considering the offer rate. Are you all understanding? So this is yes, buy FRA at offer rate is the correct answer. Are you all understanding? Very good question. Second one, if interest rate rises above the FRA rate, then A Limited under FRA. See, FRA or bought FRA. You have bought FRA at what rate? 6 into 9 FRA, you have bought at 8.3%. Assume you have bought at 8.3%. This is agreed upon interest rate, which means you will pay interest rate irrespective of whatever may be the spot interest rate. You have agreed to pay 8.3 now, which means assume tomorrow market became 9%. As a borrower, you will, okay, if the real interest rate, market interest rate is 9%, since you enter into FRA, okay, your locked in interest rate is lesser than the real market interest rate 9%, which means, okay, who will receive the compensation? The A Limited will receive the compensation. As a borrower, whoever is entering into the FRA with banker, okay, will receive the compensation, which means A Limited will receive the compensation from the bank. Okay, receive the compensation from the banker. To C should be the solution. Are you all comfortable? Yeah. Okay, buy FRA, offer rate, and 2C is the solution. Now, next, shall we move on to the next question? Okay, 3. The settlement under FRA is made at the end of the loan period, at the beginning of the loan period, at the maturity of FRA, along with the repayment of principal. This is a very, very tricky area. I told you. Okay, I've covered here many times. See, even in the marathon, I covered this concept. See, very simple. If you see here 6 into 9 FRA, let me just show you the timeline. What happens here? Month. Assume this is 1 year, 12 months here. Then this is 6 months period, and assume this is 9 months period. In this case, your loan requirement period is 6 to 9. So this is the requirement. After a period of 6 months, okay, for a period of just 3 months, you require this is the loan period. Are you all understanding? Now, in the interest rate, always I explain, the rate quoted today, assume the bank, okay, if you deposit for a period of 1 year, assume the bank is quoting at 9%, 6 months, now bank is quoted at 6.5%, assume some rate is quoted in the bank. If you go to the bank any given day, okay, you will have different interest rate for different maturity period. Now, what they say is that, see, if you see carefully, the interest rate will always be, okay, fixed in the loan starting period itself. For example, if you want to borrow for a period of 12 months, today itself, see, you will pay the interest at the end of the period, but the interest rate will be locked today itself. Are you understanding what I'm trying to say? You will know that you can quantify the interest to be paid or the rate to be taken today itself and not on the date of maturity. Agreed. FRA also, typically, when you want to borrow, okay, loan starting period is what? 6 months. And it will end, loan period will end on the 9th month. Are you understanding? So, loan starting period is 6 months. At that time itself, you will know what will be the real interest rate. Are you understanding? You don't need to wait till 9th month to know the real interest rate, know the real interest rate. Why? Because at the end of 6 months itself, you will get spot 0 into 3, na? You will get spot 3 months interest rate on that date. Okay, 3 months interest rate will be quoted. You can, okay, quantify the gain or loss. Okay, FRA is a separate contract. I told you it is a speculative. It has no relationship with the real borrowing or deposit. It's a separate contract, which means the gain or loss will be settled just like your future contract. Okay, the gain or loss will be settled. Are you understanding? Net cash settlement will happen. Here in this case, what happens? The settlement FRA is made at the beginning of the loan period. What they are effectively asking, see, at the end of the loan period, I mean 9 months, at the beginning of loan period, 6 months, at the maturity of FRA, which means when will FRA mature? Really speaking, okay, the 9th month only will be maturing. Anyway, it will different. Along with the repayment of principal, this has no connection. Repayment of principal, okay, will happen at the end of 9th month. But even without really borrowing in the cash market or real interest market, you can enter into FRA. As a speculator also, you can enter into FRA. So these options are not at all relevant. The correct option should be at the beginning of the loan period, the 6 months, because the quantification will happen at the beginning of this period. Are you understanding? Very, very important concept, clarifying question. In fact, that is why the notional principal into, okay, the real rate minus the okay, FRA rate, you do the formula which is given by institute, okay, divided by 1 plus this real rate into this months divided by year, you do respective months, 3 months, 3 by 12, like this you will apply and discount it. Effectively what you are doing, the numerator is the, okay, the cash flow, the settlement amount, that divided by 1 plus real rate which you are doing, you are discounting effectively for 3 months period and bring it to present value terms at the end of the 6 months period. This, why you are doing discounting? Because the settlement will happen in the beginning of the loan period. Are you all understanding? That is the reason why you are discounting. Okay. The next question also they have asked a tip. Okay, I expected that FRA settlement amount is discounted because interest rate are uncertain. FRA is settled in advance. Principal are not exchanged, only interest. This is the thing. FRA is settled in advance. So settlement will happen, okay, in the 6 months starting itself. Why? It will be already quantified. What is the interest to be paid? What is to be received? What is the difference? Everything will be quantified. Last question. Interest rate futures differ from FRA mainly because futures are OTC instrument, tailor-made, standardized exchange traded. Okay, futures are exchange traded derivative, exchange traded derivatives and not OTC. All the other things, okay, can be applied to FRAs but not for future. Futures are standardized and exchange traded. Okay, now next to take question scenario number 19. Okay, ABC Incorporation, a US firm, will require 6 lakh pound in 6 months and is evaluating different strategies to hedge against currency risk. The available market data is as follows. Current spot price, 1 pound is equal to $2.5. 6 months forward rate given $1, 1 pound is equal to $2.45. Now UK, okay, UK interest rate given, US interest rate given, typically money market hedge and other aspects will be tested, I think. Option contract is there, option contract is available. See, call option available on, what is that? Pound. Expiring in 6 months with exercise price of 2.46 and premium of 0.05. ABC Incorporation has forecasted the following probabilities for spot rates after 6 months. Okay, probability based question. Typical. This type of question is given in your module. Let us solve straight away the question. Since ABC will require 6 lakh pound in future, it is said to be, okay, see, this is a very very tricky question in the sense. See, in this question here, see, anything given about currency futures are not given about currency futures, which means this is about, okay, normal quotation given, forward rate given, spot and forward rate given. Okay, and here interest rates given for money market hedge. This is given for money market hedge. This is for call option, option contract, currency option. So currency option, money market hedge. Here forward rate given. No, nothing given about currency futures. Currency futures is not given. So you should not get confused. Initially, while reading, I was also expecting some data related to futures. I was also expecting that. Okay, suddenly I also got confused with that. Then I noticed that there is no future asked in the question. Normal question regarding currency. Exchange rate. Since ABC Limited will require 6 lakh pound in future, it is said to be long in dollar. See, very simple. How to identify? This person, okay, has exported some goods to pound. Assume is a pound receivable of 6 lakhs. Pound receivable of 6 lakhs. I believe pound receivable now. What is the question? No, it is payable. Assume it is payable because he wants to buy the pound from the dealer. He wants to buy. Okay, wants to buy pound. When he want to buy the pound, he may have to settle the import bill. So you made some foreign currency purchases. You need to settle the import. Now you will have to pay this. So how do I pay this? I will buy from the dealer. Then I will settle the import bill. Are you all understanding? So this is the transaction. Now ABC Limited pound 6 lakh pound in future. What I will do in the spot market? Very simple. In the spot market, okay, I have the what is that? In the future, I will require pound. In the future, I will require pound. Then in futures market, what position you will take? You will have to buy pound. Now, in the future, I will be long in futures. I will be long in futures. I told you, if you are long in futures in the spot market, what you are having effectively in the spot market, okay, if you want to buy this foreign currency, you are said to be, okay, short in the pound, short in pound. Are you all understanding? Short in pound. Okay, to understand this, try to visualize using futures, but understand that future you are going to buy today. Okay, you don't have it, which means you are short in the pound. Are you all understanding? Now, next, under a forward contract, the dollar cost is pound 6 lakhs. Okay, this pound 6 lakhs under forward contract, certain but flexible, uncertain but capped, certain and fixed, nil, certain and fixed. Forward rate, if it enter into, always it will have an obligation. There is no choice like call option. Okay, you cannot say, I won't exercise this. No, forward is an obligation. So it is certain and fixed. Whatever might be the exchange rate tomorrow, you have to fulfill the contract. Next, which hedging technique allows ABC Incorporation to benefit if the pound depreciates while protecting against appreciation? Simple and straightforward. They have not asked us any calculation. Everything is raw theory, understanding of the different hedging strategies. So here, pound depreciates while protecting appreciation. Now, you want to buy pound, right? You want to buy pound. Now, if pound depreciates, you will benefit. But okay, appreciation now you will be protected. Now, which strategy? Never it will be hedge. Okay, it will never be forward also, because these are all fixed strategies, right? The call option gives you this flexibility, which means call option, if you see that it is beneficial, you will exercise. If it is not beneficial, you will never exercise. That is what they have asked. Okay, call option on dollar will give you this flexibility. Next, if the spot rate after 6 months happens to be 2.39 per, this is call option and this is FSP. So call option FSP becomes how much? 2.39 per pound. Okay, a pound worth $2.39, which is available for $2.46. Will you exercise? You will never exercise. You will lapse it. Are you all understanding? Let the option law lapse. I think 4B is the solution. Okay, this is the 4B. Market, yes. Okay, market rate is, one second. Market rate is better than the exercise price. Okay, let the option lapse and you can buy it from the open market. Next, question number 5. Which of the following hedging methods involve borrowing and lending two currencies simultaneously? Obviously, hedge, money market hedges. Okay, you already know that C is the solution. Okay, yes, C is the solution for this question. Are you all comfortable? Shall I move on to the next case? Okay, case scenario number 20. Okay. An investor is evaluating two companies, X Limited and Y Limited, to determine which company is better investment. Both companies have different expected returns, standard deviations, and betas. X Limited has an expected return of 22% and standard deviation of 40%. Its beta is 0.86. Y Limited has an expected return of 24%, standard deviation of 38%, beta of 1.24. Okay, this is also a good quality question. Okay, this is regarding coefficient of variation. Coefficient of variation. Okay, anyway. Now, the correlation coefficient between these two is 0.72 and 20%. From the information given above, answer the following questions. Okay, which company is expected to be more volatile in absolute terms? See, the risk is measured in absolute terms, or in comparison to mean, which I called as what is that? Coefficient of variation. Coefficient of variation. Okay, this I will measure. Two measures of risk is there. Absolute term, coefficient. Here, absolute terms now. Okay, what you should use? You should use standard deviation as a standalone measure of the risk. Here, you will use coefficient of variation. This is okay with compared to mean. If you compare it with mean, compare to mean. Okay, or X bar. Are you all understanding? Now, which company is expected to be more volatile in absolute? Higher standard deviation. The company which is having higher standard deviation will be having more either. So 40%. X limited is the solution. X limited is the solution. Next, the correlation coefficient 0.72 implies that stocks move in opposite direction. The stocks are perfectly correlated. There is strong positive co-movement. Very, very good quality question. See, this question and next question are top-notch question. I'll tell you. This is these question test the heart of the the correlation concept. If you see the correlation, correlation will be -1 to +1. Okay, the -1 I call it as perfectly negative correlation, +1 I call it perfect positive correlation. This 0 in between is there, zero correlation, no correlation. This is negative, say say -0.3. These are all called as negative correlation, but not perfectly negative. Here you have fifth situation, say +3 or something. Positive correlation, but not perfectly positive correlation. And the numbers, how near it is to 1, -1 or +1, positive or negative, this is believed to be strong. Are you understanding? Which means the number, if it is 0.72, which it has a strong positive correlation. If it is near -1, it is strong negative correlation. If it is near to 0, if it is near to 0, say it is 0.1 or 0.2 compared to 0.7 or something, it is loosely correlated. It is not that much. The strength of the correlation is not that much. That you need to understand. So here in this case, what they're asking, 0.72 is there. First of all, this is positive correlation. First of all, this is positive. And there is strong positive correlation because it is near to +1. Are you understanding? The stocks move in opposite direction. Anyway, that is there, but implies that the stocks moves in opposite direction. This will be this is not there. Why this is wrong? Why? Because negative correlation means it implies in the opposite direction. Positive correlation means the stock moves in same direction. So this is not the correct answer. Next, the stock is perfectly correlated, not at all, because -1 or +1 only can be called as perfect correlation. There is strong positive correlation. This is the correct answer. There is no diversification. Benefit is not also correct. In this question, the importance is not for the solution also. I'll tell you why. The crux of the question is this part. I will tell this is more important than the solution itself. Why? Because if you see that last part, there is no diversification, benefit is happening. That is also correct. You need to prove that is also wrong, right? How it is wrong? Huh? See, very simple. I have discussed detailing in the regular lecture. I have told you many times. That is why I tell you. This is a core discussion in the diversification benefit, which you study under Markowitz portfolio theory. There I would have discussed. There, if you see this, what happens really? I'll show you. Don't think students get the confusion that if it is negative, see, negative correlation means what? The stock will move in the opposite direction. The stock will move in the opposite direction. If the stock moves in the opposite direction, obviously the portfolio risk will reduce because they are moving in the opposite direction. I take an example in the regular lecture. I take the example of the horse cart. Let's say HC is a horse cart. Horse 1 is there, horse 2 is there. Two horses are pulling it in opposite direction. What will happen? It will have negative correlation. Perfect negative, the cart will never move, which means the speed of the cart, assume it to be a risk of the portfolio. It will never move. Are you understanding why? This is also equally, powerful. That horse also equally powerful. They make the horse stable at the cart stable at one place. Are you all understanding? Maximum risk reduction will happen at perfect negative correlation situation. Now, the point here is that when you have correlation of, say here, I explain like this, all the situations I explain. I don't want to explain everything here. One point I'll explain. People misunderstand that negative correlation only will reduce the risk through diversification. Not at all. Till you reach the +1, perfect positive correlation situation, still risk reduction will happen even at 0.9999. Are you all understanding what I'm trying to say? Even if the correlation of the two securities inside the portfolio is 0.9999, then also risk reduction will happen. Risk reduction will happen through diversification process. The very, very important understanding, which means you may see the horse cart is there. In this situation, horse 1 and horse 2 both are tired and in the same direction. Positive correlation. Now, sir, how can it reduce the speed? Now, very simple. Horse 1 is running at 60 km per hour and horse 2 is running at 58 km per hour. Still, the speed of the cart will reduce because the powerful horse has not only has to pull the cart but also has to pull the weak horse. Are you all understanding? This is a classic example to show that, okay, till the point 1+1 correlation, risk reduction will surely happen. Are you understanding? That's what they have tested. The root of the concept. See, there is no diversification benefit is wrong because even if the correlation is positive, even if it is 0.99, it will still reduce. Diversification benefit will still be able to enjoy. This is the crux of the discussion. That is what they have tested in the next. If you know this concept, you will be able to, write the correct answer for the next question also. If the correlation between X and Y limited were 0 means no correlation. But okay, the correlation is not there. So two securities which does not have any correlation, if you mix it up in a portfolio, will that be reducing the risk of the portfolio? Now, yes, still it will have the diversification benefit because -1 from -1, okay, I can move up to, okay, +1 till 999. Okay, I will still be able to reduce the portfolio risk through diversification. Hence, that is what is asking. The portfolio risk would still, okay, decrease. It should still decrease. 3B should be the correct answer, if I'm not wrong. Okay, 3B should be the correct answer. But the explanation is not, yes, of course, lower correlation. Even no correlation should improve the diversification benefit. That's the, real solution. Okay, correlation of 0.72 indicates stop positive correlation. Okay, very, very, very important. These two questions. Okay, I am very happy that these things you will never see, you will never be able to understand in the regular, the descriptive questions. This you can test through the MCQs. That is why MCQ comes into picture. Very, very conceptual. Now, next. Which type of risk can be reduced by forming a portfolio of X and Y limited? Obviously, unsystematic risk. These are all systematic risk. Systematic risk will be present. It can never be reduced through diversification. Only unsystematic risk can be diversified away. Next, if market volatility increase but betas remain unchanged, the expected return, again mistake. Again, I'm seeing the expected return. This is actually should be required return. KE should be there. Okay, this is never expected return because there is expected return, not mean return, which you compute through ex ante and exposed data. That is what is called as expected return, mean return. Here, the CAPM nale SML return, okay, the security market line, which is called as KE, acquired rate of return. Both are very, very different. Anyway, the market, the expected return and the KE required return will be the same only when the MPS, the share price, the share is trading in the market at the fair price. Anyway, if the market volatility increases, beta remain unchanged. Now, beta is only required to calculate. So here, okay, beta is, see, I don't care about the individual market volatility. I only care about the, beta, which connects the security with market. So if beta is unchanged, obviously the KE, required rate of return, will also be unchanged, remain unchanged. Okay, 5 CAPM, that should be the solution. Are you all understanding? Anyway, with this, we are through with the case scenario number 20. Okay, we'll discuss from case scenario number 21 in the next video. Thank you.